everyone, this is Ashley Jamerson coming to you from Ashley Lambert Realty, and today I'm not in my car, and that's because I wanted to sit and chat with you about a topic, a question that comes up all the time, whether I am putting a client under contract with an existing home or a new construction home. It just comes up. And it is, what is the upfront cost of going under contract? When I'm asked that question, I always talk about the two buckets of money required to purchase a home. So first and foremost, there are two buckets. There is the down payment required by your loan product, whether it's conventional or FHA, and then there's the closing cost. There is a pesky third bucket that is popping up more and more recently because we are in a crazy hot seller's market. We'll talk about that last because that bucket totally annoys me, to be honest. It just annoys me. But let's talk about the first bucket. The first bucket is going to be your down payment. The type of loan product that you are pre-qualified or pre-approved for will determine how much your down payment will be. If you are approved for an FHA loan, the minimum down payment is going to be 3.5% of the purchase price. If you are approved for a conventional loan, then your down payment will be at minimum 3% of the purchase price. You can always put more money down. I'm just going to talk about minimums here. And the purchase price that I'm going to use as my example throughout this video is going to be $330,000. I have all my notes on my lap just so I know what I'm talking about. So if you are doing a conventional loan and you're doing 3% down, your first bucket, your down payment bucket, is going to have $9,900 in that bucket. If you are doing an FHA loan, which is 3.5% of the purchase price, then for my example, your down payment is going to be $11,500. So that's already sitting in bucket one. So how do you feel bucket one? You can fill it a few ways. You can have your savings to go in there and you can take the money out at closing. You can get a gift from a family member. I was going to say family member / relative, same thing, but a family member can give you a gift. That can go into the down payment bucket. You can also get down payment assistance. That can go into the down payment bucket. So there's lots of ways to fill it, but that's pretty much the very first bucket. I always tell people yay, you got approved for a loan. Now, do you have that money? It's like, they can have a plan for it. They can get those gifts, letters, things like that. I can help them with that. Down payment assistance, savings, but there has to be a plan for this first bucket or the letter is worthless, pretty much, okay? So again, with a conventional loan, the minimum is 3% down, and with an FHA loan, the minimum is 3.5% down. And you can always put more money in that bucket, and what that does is it goes towards the principal and can possibly make your payment a little bit less. Let's talk about bucket two. Bucket two is the closing cost, and I think the part that confuses my clients the most when it comes to the closing costs bucket is that they always give a range on the front end. And the reason why there's that big range is because a lot of the items in this bucket are prorated by the day. So your taxes are prorated. If you close on the 3rd versus the 29th of a month, that number will be different. If you close the 3rd versus the 29th, your insurance will be a little bit different because it's prorated. Okay. In that closing cost bucket is also your escrows to start your escrow account. Escrows basically means that when you make your mortgage payment every month, it's PITI. Your principal and insurance is steady. As long as you have a fixed rate mortgage, that P and I of PITI will stay constant. The taxes insurance can go up or down depending on what city you live in, what county you live in. That can change. 1/12 of your tax bill and your insurance bill is put inside that escrow account, and then when the tax bill or the insurance bill becomes due, your escrow will pay for that. And that's the rule of thumb until you pay the house off, and then you're responsible for paying your taxes once a year and your insurance once a year. A good estimate for the amount of closing costs is about 3% of the purchase price of the home, but once you get to a certain amount, that doesn't work. That rule of thumb doesn't work. So for my example of a $330,000 house, and I actually looked at a closing Alta statement to get this number, was around $8,800. So those are your two main buckets. Again, you have your bucket one, which is your down payment, and then you have your bucket two, which is your closing cost. So let's talk about the fees that are expected once you go under contract, because that's more so at the end there. The very first check that I will be asking for is the due diligence check. This fee is a fee that is paid directly to the seller to take their house off of the market, so you can do all of your due diligence. People ask me, so what is this amount? Is it written in stone? What's the average? And there honestly is no rhyme or reason. It is how much you feel you want to give the seller to take their house off the market. A year ago or 2 years ago, that amount was like $500 to $1,000 or $500 to $1,500. It wasn't as crazy as it is right now. I have seen $3,000, $5,000, even $20,000 being offered. And not all of those offers were accepted by the seller, which means they probably accepted something higher, which makes no sense to me in some situations. But that due diligence fee is non-refundable, guys. It's non-refundable. You write that check to the seller cashes that check, they take their home off the market so you can do your due diligence. And you don't like something about the house, because in North Carolina, every house is sold as is, and the seller doesn't have to fix anything. They can say nope, and they can put their house back on the market and keep your money. If you want to rewind that so you catch it, I'm 1000% sure that that will like shock so many of you guys, especially if you're moving from out of state. But yeah, in the state of North Carolina, the house is sold as is. The seller does not have to fix anything, which is why when I show property, I'm running water, I'm wiggling toilets, I'm making sure that the house in its as is phase will make my client happy. If it doesn't, I make sure they know that there's no guarantee the seller will fix that. But let me digress, because I can talk forever about home inspections. That due diligence fee, again, is written to the seller. Now, let's say you close, which 90% of the time you will close. That money that you put down will go towards your down payment bucket, okay? So let's say that you're with a conventional loan. So you put down $9,900 and you offered the seller $4,000 in due diligence. What's left in that bucket is $5,900. Another check that I will be asking for, and typically I get these at the same exact time, but the due diligence money is due immediately, but the earnest money is due within 5 days of contract. And that check is sent to the escrow agent, which in my case, 9 times out of 10, is the closing attorney. So you would be writing a check to the closing attorney, and they will hold it in their escrow and start working on your file. When you close, that earnest money is also put into bucket number 1. So let's say that you did $1,000 in earnest money. So now you have the $4,000 due diligence, the $1,000 earnest money. So when you close, whatever your cash to close amount is, which is both buckets together, I'm probably confusing you guys, will be reduced by $5,000. So the money's not lost as long as you close. 2 more things that you will have to pay for very, very quickly is the cost of all of your inspections, which is around $500, and then your appraisal, which is around $475, both depending on how big your house is and where it's located, if it's a crawl space, basement, or slab, things like that. But typically I've seen $500 for inspections, and I've seen $475 for your appraisal. That's immediately during the due diligence period. That due diligence period is approximately 14 days, 14 to 21. Back in the day I could squeeze 21, but closer to 14 days. It's a rush, guys. So as soon as you go under contract, I am ordering that home inspection, the lender is ordering that appraisal, and we're just hoping that they both have time to get out there to the house and that we get our reports back in time to negotiate any issues that pop up with either report. So, due diligence money, earnest money, inspections, appraisal. Those are things that you can expect to pay for very, very quickly if you are lucky enough to get your offer accepted in this crazy market that we're in right now. So let's talk about this crazy market that we are in right now. I have been on the listing side for existing homes, the buyer side for existing homes, and I have worked with new construction a lot recently. And this whole theory of highest and best it makes me mad. It totally makes me mad, because highest and best is not always the highest purchase price. Sometimes it's who gives the most due diligence money, what type of loan they are using, comparing FHA, VA to conventional to cash. Where are all of these cash buyers, investors coming from? How quickly can they close? If you are purchasing with an FHA or VA loan or even USDA, it can possibly take 35 to 45 days to close. And please do not throw in down payment assistance programs, because that would definitely put you in that 45-day realm of closing. And because sellers have the upper hand in this seller's market, they want the house to close quick with the least amount of problems and for the most amount of money. And they can do it. It drives me crazy. So highest and best is something that you probably see all the time in a little description, like, hey, we have received multiple offers. We're expecting highest and best. Please submit your highest and best by tomorrow at 3 p.m. Lots and lots of things like that. Or the house is coming soon and then it goes under contract and you're like, what happened? So this market is crazy, but let's talk about highest and best and the appraisal. So you see this beautiful house, you go under contract for it for $330,000. The house was listed at $310,000. Okay, so you said, okay, I'm tired of this market, I'm stressed out, I'm just going to throw it in the bag. I am going to offer $330,000, and that will, entice the seller to select my crazy good offer, because who wouldn't want $20,000 more than what they asked for? Okay, so you go through all the process, you put your due diligence money down of $4,000, $1,000 earnest money. You're spending all of this money, and then you get the appraisal back, and the appraisal comes back at $319,000. The bank will only lend you enough money to buy a $319,000 house, or this house is only worth $319,000. Now you can take that appraisal, and we can, if I'm the buyer, I'll say, hey, seller's agent, can you please work with the seller and see if they will lower the price to $319,000. I know I promised that I would pay $330,000, but I can't do that. I can't. And so the seller will go to their client and they will say, it didn't appraise, I didn't think it was going to appraise, but they now want to lower the price to $319,000. That seller may say, that's fine with me, that's $9,000 more than I was expecting. Sure, why not? Let's do it, let's keep it going, let's close on time. Or the seller could say, they promised me $330,000 and that's what I want. If they can't pay me my $330,000, I'll just put it back on the market, or I will accept one of these other highest and best multiple offer, backup offer situations, because we had 20 offers, on our house. So that's like a little bit of a conundrum, and it's a little bit of risk that you take. If that seller says, I'm not lowering the price to meet the appraisal, they can keep your $4,000 or whatever your due diligence fee was. You'll get your earnest money back as long as you did all of this during the due diligence period, but you lost $4,000 plus your inspection, plus your appraisal. And when that happens, people look at me like, Ashley, oh my God, you lost my money. What am I going to do? And I'm like, I told you that this house was not worth $330,000. So that's the one scenario. Let's say that, you're like, fine, I want the house, I have the money, let's just do it. If the seller says they're not going to lower the price, you keep it at $330,000. So not only do you have bucket number one, which is your down payment, I'm going to rock with the conventional loan option here of like $9,900, plus your closing costs of $8,800. Now you have to pay the difference, because remember, the bank is not going to loan you more than what the house is worth. So now you have to bring the difference. So $330,000 minus the $319,000, which means you have to bring an additional $11,000 to the closing table. So 11,000 plus 9,900 plus 8,800 is $29,700 for my example of this overpriced $330,000 house. So what do? You know, those are the buckets. That's the money of buying a home. Now, the closing cost bucket can be reduced if you are lucky enough that the seller will pay a portion of your closing costs. That could reduce it a little bit. And there's some negotiations that can happen there. If you are buying new construction, a lot of the times the builder will have an incentive. If you use their preferred lender, they will pay a portion or all of your closing cost. So that can help lessen that money there. So let's make this $29,700 situation a little bit sweeter. Let's say that you get a gift from a family member, and combined with your due diligence and your earnest money that you paid up front, that first bucket of your down payment is completely taken care of. Then let's say that you're buying new construction and that builder is agreeing to pay all of your closing costs minus a few things. So you may be left with about $1,000. The first two buckets are taken care of. So if you were in a crazy appraisal situation and the seller or the builder was like, I am not lowering the price for you, then it might be a little bit more reasonable to bring the difference. But if it was me and my money and my family, I would not pay more for a house if it didn't appraise. You can always get another appraisal if it's not FHA. If you're doing conventional, you can always get another appraisal, but just knowing that one of the largest investments is overvalued and I'm putting my money into it, I'm not comfortable with that. So that's not advice that I give my clients. So guys, I hope this video explained the upfront cost of going under contract, as well as the two main buckets plus the bonus bucket, because this market is crazy, of buying a home. If you have any questions, put them down below and maybe I'll answer them in another video. Now that I'm set up and a little bit more comfortable in our new house, I will be able to sit down and make more of these explaining educational videos for you guys. Okay, so until next time, subscribe, share this with a friend, schedule a time for us to chat in your very own home buyer consultation. Again, that link to my calendar is below. But until next time, I'll talk to you later. Bye.